This video is for educational purposes only and is not financial advice. I am not a financial advisor. Investing involves risk, including loss of capital. Any tools or strategies mentioned do not guarantee profits or future results.
Every investor seems to be asking the same question right now. Are we in an AI bubble? Some analysts say artificial intelligence is the biggest investment opportunity of our generation. Others warn it's becoming another dot-com bubble waiting to burst. And the truth is, both sides might be right. Because what if the market still has room to go much higher? Before eventually crashing? That's the idea behind a market thesis that has been gaining attention recently. The theory isn't that investors should avoid AI. The theory is that the final stage of this bull market may still be ahead of us, and if that's true, the biggest gains could happen during the most dangerous part of the cycle. Think about previous market booms. The roaring 1920s, the dot-com era, the housing boom before 2008. In many cases, the largest gains happened near the end of the cycle, just before conditions changed dramatically. That's what some market historians refer to as a melt-up, a period when prices accelerate higher because optimism becomes almost unstoppable. And according to one market strategist, artificial intelligence may be creating the conditions for another one. The argument starts with a simple observation. A handful of technology companies have driven an enormous percentage of recent stock market gains. Microsoft, Nvidia, Amazon, Meta, Alphabet. These companies are spending hundreds of billions of dollars building the infrastructure needed to support artificial intelligence. New data centers, new chips, new networking equipment, new power generation projects. The scale of investment is unlike anything we've seen in years. Naturally, that raises concerns, because whenever investors see massive spending and rapidly rising stock prices, memories of previous bubbles begin to resurface. But supporters of the melt-up thesis believe there's an important difference. During previous bubbles, many companies relied heavily on debt, speculation, and unrealistic business models. Today's largest AI companies are generating enormous amounts of cash from existing businesses. They're not borrowing money simply to stay alive. They're funding much of this expansion from their own profits. That doesn't mean a future crash is impossible. It simply means the current environment may be stronger than many people assume. And that's where the debate becomes interesting. If the AI boom continues, investors who exit too early could miss significant gains. But if a bubble eventually bursts, investors who stay too long could suffer substantial losses. So how do you balance those two risks? One approach comes from market analyst Eversole. Rather than treating AI as either a buy or sell decision, Eversole believes investors should focus on identifying when the underlying conditions begin to change. His approach centers around something he calls the Redline signal. The concept is straightforward. Instead of trying to predict the exact top, the signal is designed to monitor stress building within the AI ecosystem. Factors like spending levels, financing conditions, market concentration, and broader market behavior can sometimes provide clues about whether a trend remains healthy or is becoming increasingly fragile. In other words, the goal isn't to guess, the goal is to follow the evidence. As long as the data remains supportive, investors participate. When conditions deteriorate, investors become more defensive. That philosophy forms the foundation of Eversole's True Wealth Research Service. The service focuses on identifying opportunities that are often overlooked by the broader market, while also emphasizing risk management and exit strategies. Rather than constantly chasing headlines, Eversole looks for investments he describes as cheap, hated, and already moving higher. The current AI melt-up thesis is simply the latest example of that broader approach. What's interesting about this strategy is that it acknowledges two realities at the same time. Artificial intelligence could continue creating enormous wealth, and eventually, the trend could become excessive. Both outcomes can be true. The challenge for investors is figuring out when one becomes the other. Of course, no indicator can perfectly predict the future. No signal can guarantee investors avoid every downturn, and no strategy works all the time. But the question Eversole is trying to answer is one that almost every investor faces today. How do you participate in one of the biggest technological shifts in history without becoming the person left holding the bag when the music stops? Whether the Redline signal ultimately succeeds or fails, that's a question worth paying attention to. Because the biggest investing mistake isn't necessarily buying into a bubble. It's failing to recognize when the environment has changed.